If you are making these 5 mistakes in your business, you are increasing your chances of getting audited. Today, I'm going to tell you what they are and how to avoid them. Welcome to the Savvy or Surrender podcast, the show where business owners stop guessing about their money and start taking control. I'm Stephen Young, founder of Savvy Tax Strategies and Bookkeeping, profit first professional, and the guy contractors call when the IRS feels a little too close for comfort. If you're trying to build profit, lower taxes, and finally get clarity with your numbers, you're in the right place. Don't forget to like, subscribe, leave a review. If you like what you hear, I would greatly appreciate it. So let's get into it. Okay, so we want to first explain that, number one, the IRS audits are not random. They know exactly what they're doing. They use a ton of not just AI, but just big data in general to be able to figure out the algorithm of what makes sense and what doesn't. They have patterns, mismatches, high-risk activity that are common, especially in the trades for contractors that they do. So when we go through these, just understand that, number one, most audits these days are not a full audit. You're probably not going to, at least not right away. You're not going to sit down with an auditor where a revenue agent is what they like to call themselves, where you sit down with somebody and they look at everything and they want you to bring everything in. Most likely what is going to happen, because they have that algorithm, because they know the outliers in the numbers, most likely what's going to happen is you're going to get a letter that says, hey, your expenses in this category don't make sense. Can you please provide this information? Whatever it might be. It could be in advertising. I've seen it in travel. I've seen it a lot in auto. So in those areas, that's where we need to be a little more careful. But if you're going to say that maybe you do $100,000 a year in sales and you had $90,000 in auto expenses, that's going to raise a red flag, and they're going to ask for copies of that information in your mileage log and all that kind of stuff. So just understand, I guess, first of all, that normally not a huge audit first, at least. Normally first, they're going to say, here's what we are looking at. Please send us this information. And then they'll tell you how much money you owe based on what you send them. Okay, so red flag number 1 is underreported income. And here's why it triggers an audit. The IRS receives copies of all the 1099s from customers, payment processors like Stripe, PayPal, Square, and all the banks. So if you are getting money from a credit card, the IRS knows about it. If your reported income is lower, even slightly, you're flagged automatically. So a lot of times contractors will mess up a couple of areas. One is forgetting 1099s from general contractors. If a general contractor is sending you a 1099, that has to get reported. Now, if you are a corporation, an S Corp or a C Corp, you don't get 1099s, but you'll still get the 1099 from the general contractor. You want to make sure that it's actually in your S Corp name or in your corporation name, because if it's in your personal name, then it's possible that it's going to be reported on your personal, not even possible, it will be reported on your personal income tax report. And so then you have to claim it there and show that it moved over to the S Corp, that it was actually there. So it's very important that you give, especially if you change to an S Corp during the year, you want to make sure that you give an updated W-9 to that general contractor or whoever you're giving the W-9s to. And so big contractor mistakes, again, forgetting the 1099s, not reporting cash jobs, depositing business income into personal accounts, or underreporting revenue from places like Venmo, Zelle, and PayPal. Now, there's been a lot of confusion around what's being reported from places like PayPal or Venmo. And it's changed every year. It was supposed to go down to $600, and then it went back up to $20,000. And so the one big beautiful bill, one of the things that it did was it solidified the rule on what that is. So you'll get what's called a 1099K is what you'll get from Venmo, PayPal, and each state might have different requirements, but federally for the IRS, it's $20,000 and 200 payments. So if you have, for whatever reason, Venmo transactions in or PayPal, and it's over $20,000 for the year and over 200 transactions, has to be both, you're going to get a 1099K and it's going to be sent to the IRS. If it's under that amount, you're still going to get a 1099K, but it's not going to go to the IRS, so they won't see that. But that doesn't mean they don't know it, they don't track it. So you still want to make sure that your deposits are matching your income. You want to use some kind of bookkeeping software. There's QuickBooks Online, of course, the big bad evil man of them all. And then there's other places like FreshBooks and Wave Apps. There's a new one called Kick that I'm helping the development team on that looks really, really exciting with AI things and some of the stuff that it's doing. So you can take a look at that. You want to make sure that you're recording all payments, even if it's in cash. Deposit that money in the bank account and be able to track it. You're just using your expenses against it. You want to keep copies of client payment statements. So anything that they send you, if the general contractor, they send you some kind of a payment slip, you want to make sure you hold on to those. Red flag number 2 is excessive or unusual deductions. So the IRS expects your deductions to be proportionate to your revenue and the industry average, kind of like I was talking about before. They're going to see in the algorithm the red flags of, hey, this doesn't make sense based on their industry and based on their income, things like that. So extremely high vehicle expenses, that's like one of the first things that they're going to see. Again, if you did $100,000 in sales and you have $90,000 in auto expenses, that's a red flag. Something is wrong there. Large tool or equipment write-offs without any documentation. Now, I've talked about this on a previous podcast, I think even just last week's podcast, where we talk about the bonus depreciation and how it changed to 100% with the one big beautiful bill. How if you have a safe harbor written into your operating agreement, you can automatically write off anything over $2,500. You don't have to make it an asset on your balance sheet. But if it is more than $2,500, yes, you can write it off now using bonus depreciation, but you have to do it the right way. You don't just simply get to write it off. You don't just simply get to get rid of it or expense it. You still have to make it, do it correctly, have a capital expense, put it on the balance sheet, all those things. So if you're buying a $50,000, $100,000 backhoe, something like that, you still have to do it the correct way, even if you're getting to write it off the whole year or getting to write it off all in 1 year. High travel and meals. If you've got a lot of travel expenses, maybe they're justified. That's okay. We need to be able to make sure we document it. Anything over $75, I would hold on to the receipt and talk about why. If it's under $75, they're not going to be asking for the receipts. Low net profit year after year. I see this a lot where clients want to write off everything possible, right? And I'm all about using tax strategies, but we have to make sure that we're doing it correctly. The kind of rule to go by is 2 out of 5 years, you need to show some kind of a profit. So if year 1, you don't make money, that's okay. Year 2, you don't make money, that's okay. Year 3, if you are in your 3rd year in business and you're not making any money, something is amiss, right? Why are you still in business? Are you a business or are you a hobby that you're trying to write off all of your expenses? So that's when things start to get a little tricky and the IRS starts to wonder what exactly it is you're doing. So things to avoid or how to avoid an audit or a red flag here is, of course, to document everything. Keep receipts. Again, over $75 is where kind of the borderline of what I say, you need to keep them. Keep it digitally. Take a picture of it real quick. If you have QuickBooks Online, their app is actually really good and is a great way to store your expenses. Just take a quick receipt or picture of it, and now it's in there. Avoid commingling personal and business expenses. Keep those completely separate. You want to have a different checking account for your business and your personal expenses. And of course, you want to work with a tax pro to justify and document legitimate large deductions. One of the things that we like to try to do as well is to avoid expense clumping. And what that means is, let's say we have marketing and advertising where you are sponsoring lots of different events. Maybe you're doing things for the chamber. Maybe you're doing things for another association, builder trades association, whatever it is. Let's separate those out in categories that make sense. So rather than putting them all together in one, where now we have this really big marketing expense, maybe we can separate it out to sponsorships and advertising on online advertising and magazine advertising. And maybe we have 4 or 5 different expense categories so that we can show it a little bit better. Same thing with auto. If we're not tracking oil changes and transmission repairs, again, because you own a Ram, I'm a Ram owner, so I can make fun of Ram owners, right? So if you have large expenses, auto repair expenses, don't put that in the same category with gas. You want to try to keep it separate so that we can show all the different expenses and not have them all clumped together. Okay, so now red flag number 3 is if you've misclassified workers with contractors versus employees. And this is a big one for the trades. The IRS red flags are paying employees as 1099 contractors, subcontractors who work full-time for you, paying subs without collecting W-9s, not issuing the 1099 NECs. So here's where the test comes in. If you control when they go to the job site or when they work, you control their behavior. You're not asking for an invoice. You're just sending them. They get paid every 2 weeks like all the other employees, or every week, or whatever it is. So you control their financial. You tell them how much they are going to make. You control all of their dependents, and maybe you even give them business cards depending on the position that they're in. That's an employee. There's like 6 different tests, but really what it comes down to is if you control what they do and when they do it, you control how they do it, you control how much they're going to make on it, don't request invoices, send them a check automatically. Those are all signs of being an employee, and you are going to get in trouble for not withholding taxes. You're going to get a big fine for it. So the other issue is W-9s. When I did insurance audits, I would see this all the time where the general contractors would not collect W-9s from the subcontractor. And of course, they would pay them. And once they paid them, all of a sudden, they couldn't get a hold of the person. They couldn't get the W-9. They couldn't get the certificate of insurance. No surprise there. They've been paid. They don't care. They're out of there. Especially companies that maybe are fledgling and they get paid and they're gone. They're out of business. They move to another state. So before you pay that subcontractor, make sure you get a certificate of insurance and a W-9. Then you can issue a check, not beforehand. I don't care how much they're pressuring you. Make sure you get both of those documents. You want to use proper and actual written contracts. Now, I live in Idaho, where it's changed a little bit in the last 15 years since I've lived here, but even before then, and certainly, even when I moved here originally in 2010, I was told a lot, hey, we just do by a handshake. We're a verbal contract place. Coming from LA, that was crazy to me. But I don't see it as much anymore. The more Californians have moved into Idaho and Washington and Oregon and everybody. But it certainly used to happen a lot. So if you are one of those old school contractors who do everything by, verbally and a handshake, you're going to get into trouble. It's going to happen to you eventually where you need to prove something and you're not going to have it. And the IRS doesn't go off of handshakes. So get proper contracts done, have them in writing. And treat your subcontractors like truly independent businesses. You don't get to dictate everything. You can tell them, hey, this job site starts here, and maybe but if they get there at 9 o'clock in the morning or 9:15 in the morning and they were supposed to be there at 9 or 8 or whatever, you don't get to dock anything. You're not paying them hourly. You have to track how much you're controlling their independence there. So, and then last, with 1099s, anybody who makes more than $600 a year for you through that calendar year must be issued a 1099 by January 31st. This is a hard and fast rule. You will get fined if you do not have 1099s sent to everybody by January 31st, anybody who made more than $600 with you. Red flag number 4 is messy or missing records. So if you can't provide support for deductions, the IRS assumes that they're invalid. What that means is if you don't have a written mileage log, and so if you've never done your taxes personally, in the auto section, when you are doing your miles, it will ask you if you have verification of the miles. And then the next question says, is it written? If you say no, it's not written, they don't allow you to take the deduction in the software. If you say yes, it's written, then you better have it in writing. Now, most contractors are not going to sit there and put into Excel or at the end of every night write into a notebook how many miles they wrote for the day. But at least if you could take pictures or keep the statements from Jiffy Lube or something we're coming up here the beginning of the year, take a picture of your odometer so that at least from 1 year to 1 year you can show what the mileage change is. That's at minimum. There's also, again, apps. I've talked about this on previous podcasts. The QuickBooks Online app has a way to track your mileage. There's also another app, I think it's like $6 or $7 a month, for Mile IQ. Fantastic app. Swipe left, swipe right. It's personal, it's business. If you're mixing a business, if you have a vehicle that you do business and personal on, it's perfect for that. And so you want to track all of that. And then again, receipts over $75, hold on to those. Cash transactions with no documentation, that's a big red flag. Estimates instead of actual numbers, you should never have, or at least it should rarely ever happen. Sometimes it's just going to happen by nature, but you should never have let's say marketing expense of $3,000. Now, unless you sponsored one event and it was exactly $3,000, that's going to be a red flag, right? But if that's the only one, fine. But if you have marketing expense at $3,000, auto expenses at $6,000, office supplies at $5,000, and everything is a perfect, nice round number, that is clearly an estimate. The IRS is going to call that a red flag. They are going to ask you for proof of that. So keep digital copies of receipts. If you buy something online, you've got the receipts there. If you're buying things on Amazon or Lowe's or Home Depot, all of that is tracked. And at the bare minimum, buy things on a debit card or credit card so that you have that level of documentation in the statement. But beyond that, if it's over $75, I highly recommend keeping the receipt, or at least have a way through their system that you can get it. If you've got a Lowe's Pro account, Home Depot Pro account, you'll be able to go in there and get that receipt, from them. Again, use the mileage apps. We talked about that. And hold on to all of those invoices. Use bookkeeping software, QuickBooks Online, Wave Apps, FreshBooks, Kick, all those things. Have a clean profit and loss and balance sheet each month. Every month, go into your financial system, whatever one you use, and pull a balance sheet, pull a profit and loss statement. Make sure it's correct. Do the profit and loss detail report in QuickBooks Online and see what that generates, and it just gives you a little bit more information to be able to track whether or not things are getting categorized correctly. Okay, our last one, red flag number 5, claiming the home office deduction incorrectly. So many contractors assume that this is a risky thing, but the risk is not actually in claiming it, it's claiming it incorrectly or not claiming it at all. So what's going to trigger an audit is claiming too much square footage, including rooms that aren't used exclusively for business. I remember reading this guy's book that said, you can claim the entryway, you can claim the hallway, you can claim the living room because maybe you have clients sit in there. That's what's going to cause a red flag. If you're trying to write off half of your house, if you have a 2,000 square foot house and 1,000 of it is being used for your business, you better have proof. You better have pictures. You better have documented the square footage, something, because that's probably not going to make sense. Now, last week's podcast, we did talk about using the garage for inventory or for tools or whatever. That's fine. But just make sure that if you're going to include that you also include it in the total square footage of the house. So if you have a 2,000 square foot house and you have a 1,000 square foot shed, that's now 3,000 square feet. And so now maybe you use 1,000 square feet, but it's 1,000 square feet of the 3,000. So you want to make sure that you're tracking it. If you have multiple offices, again, perfectly legal. The IRS has actually, there was a court case that showed it was a doctor actually who had a doctor's office, and then he claimed his home office as an office as well. And that went to court, and it was allowed because he clearly worked from home. He had a dedicated home office, and then he would drive to the medical office where he'd see his clients and everything, but he did his administrative work at his home office. That was allowed. So you're allowed to do that. You're allowed to have multiple offices. And when you're going from one office to the other office, that is work related. So now you can actually claim that mileage as well. Those are all fine as long as, again, it's being documented. So you want to have a real workspace. Measure the square footage, keep photos, utility bills, calculate the business percentage correctly. If you take all those bills that you have for the month and your business occupies 10% of the house, then it gets 10% of the bills. Or you use the estimated amount of $3 per square foot, you get up to 150 square feet basically for that one. Only claim legitimate storage space for inventory and equipment. So if your wife is parking the car in the garage, or your husband is parking the truck in the garage for his personal use, and you're trying to say the whole garage is being used for business use, that's not going to work. So you just need to make sure that you're able to legitimately show in the event of an audit that you've got this storage space is only used for business. If they go walking into your garage, let's just say the revenue agent comes to your house and they go walking into the garage and you're like, yeah, this garage is used for business purposes, but it's got gym equipment in there because you're using it for equipment or for working out, you're probably not going to be able to pull that one off. They're going to say, okay, it's not being used exclusively for business. So the IRS, they don't expect perfection. They know that this isn't always, exactly how you can't document everything perfectly. There's lots of different forms, and if you take your return information to one tax professional and you take it to another tax professional, it's very possible they get two different numbers. When I was going to Boise State University and taking tax classes, that would happen where the professor would get one answer and five other people we had like 5 different answers in the class. And obviously a couple of them were probably wrong, but mine was right. So my point being is that depending on what form you use, what method of depreciation you use, what method of using for the auto and for the home and things like that, you're going to get different numbers. So the IRS, they just want consistency. They want documentation and they want honesty. So if you're listening to this and thinking, okay, I definitely need more clarity with my taxes and cash flow, then you need to check out the Savvy Tax Hub. That's where business owners get the tools, templates, and guidance to stop guessing and start making confident financial decisions. You'll get monthly support, 2 fresh videos, a strategy call, and 25% off tax prep, all for $147 a month. It's the easiest first step toward feeling relieved, organized, and actually in control of your money. Go to savvytaxhub.com and get yourself out of the financial fog. All right, that's today's episode of Savvy or Surrender. And thanks for listening. Stay savvy, take control of your money, and never surrender your profit to bad decisions or to the IRS.